Are stablecoins the future of cryptocurrency? The extreme volatility of the cryptocurrency market presents significant risk for investors. It causes prices to move from one level to another without always making a pass through the immediate level. While 2017 saw a dramatic rise in cryptocurrency values, 2018 saw them fall sharply. In order to respond to this problem, stablecoins have been introduced. Concretely, what are they? How do they work? What are their different forms of support? Everything you need to know is in this guide. So what is a stablecoin? A stablecoin or stable money is a digital asset that serves to bring stability to the cryptocurrency market. It is appended to fiat currencies while providing a balance in their valuation. Thus, a stablecoin allows investors to protect themselves from speculative fluctuations and avoid loss of capital. It does this by using collateral with another traditional financial asset. This is usually the dollar, but the euro, pound, sterling, or Japanese yen can also exist in stablecoin. The same is true for tangible assets such as gold, oil, diamonds, etc. In all cases, the price of a stable coin varies proportionally with the price of the financial asset it is backed by. For example, Tether USDT follows the value of the dollar. 1 USDT equals $1. It is pegged to actual dollars stored in financial institutions. If the price of the latter increases, so does the price of the Tether. What are the advantages of stablecoins? Well, the main reason for the introduction of stablecoins is the volatility of cryptocurrencies. Indeed, the fluctuation of asset values in the crypto market is enormous, as is the case with Bitcoin and Ethereum. By indexing to a more stable currency, companies are guaranteed to hold on to their tokens without them soaring or crashing in the short term. In addition, stablecoins are accessible to anyone via the internet and are open internationally 24/7. They do not require a bank account and can be transferred anywhere. Moreover, the transmission of stablecoins is fast, secure, and affordable. For example, an entrepreneur can spend several $million of USD coin for less than $1 in fees. But that's not all. In the context of a cryptocurrency and stablecoin exchange, there is no taxation. In other words, the professional does not pay taxes, regardless of the capital gain made. The other advantage of stablecoins is that they can be used as a means of storing value to protect funds. In fact, when the market is experiencing great turbulence, it may be wise to transfer one's investment into stablecoin for a relatively short period of time until the market stabilizes again. The investor does not make a profit but secures his or her funds. On the other hand, stablecoins offer the opportunity for virtual trading platforms to integrate new crypto fiat pairs in order to earn more revenue. Finally, stablecoins are a good aid to understanding the psychology of the cryptocurrency market. Given the volatility of prices, it seems difficult to interpret market sentiments when investing in cryptos. With stablecoins, the professional observes the trends, fall or rise, of stablecoins over the last 24 hours. A drop in the price of stablecoins means a rise in the price of crypto assets. What are the different types of stablecoins? Stablecoins can be divided into three main categories. They differ in the media on which they are backed. These are the stablecoins available on the crypto market. Centralized stablecoins, also called stablecoins with fiat collateral, these are digital assets backed by fiat currencies such as the dollar. To do so, the company issuing stablecoins must have equity to match its investment. This guarantees the stability of fiat currencies. Let's take the example of Tether, whose price is indexed to the US dollar. 1 USDT equals $1. In order to issue 1 million USDT coins, the structure will need to have a capital of $1 million. The advantage of this type of stablecoin is that it's based on relatively stable government-backed assets. In addition, it is a solid design that is easy to understand. Nevertheless, there is no way to verify the availability of funds at the stablecoin issuing company. The lack of transparency on reserves is therefore a major drawback of this fiat currency medium. Other notable limitations include the high costs of complying with financial regulations and expensive auditing fees. Decentralized stablecoins. Unlike centralized stablecoins, decentralized stablecoins are attached to cryptocurrencies such as Bitcoin, Ether, Tether, Ripple, they operate outside of the traditional banking system as no centralized entity manages them. MakerDAO dominates this category with its stablecoin named DAI. This is indexed to Ethereum and backed by several cryptos like USDC, Ether, Wrapped Bitcoin. If the value of Ethereum increases, the value stored in DAI will remain the same. However, with such a stablecoin, the investor can store it on an electric wallet. Commodity-based stablecoins. There are cryptocurrencies whose prices are indexed to those of commodities. These include gold, silver, or oil. The best-known stablecoins in this category are Tether Gold, XAUT, and Pax Gold, PAXG. In any case, the issuing structure must have available a quantity of gold proportional to the number of coins put into circulation on the market.